everyone, and welcome to this edition of NordSIP Insights, where today we're going to explore a somewhat less known area, that is the intersection between factor investing and sustainable investing. And as everyone who's familiar with the concept of environmental, social, and governance knows, sustainability experts often refer to the E, the S, and the G as factors, which might be slightly confusing for a traditional investor in factor strategies. Well, not all factors were born equal. And to help us disentangle the concepts and bring some more clarity and some depth in the discussion, we have invited today Emily Lawrence, who is the Director of Sustainable Investing and Client Engagement for the Institutional Client Group at Northern Trust Asset Management. Welcome, Emily. We're very happy that you could join us today. Could you tell us a little bit more about Northern Trust's history with sustainable investing, just to kick off the discussion?
Yeah, absolutely. Northern Trust Asset Management has been in the sustainable investing field for over 30 years. And we manage about 139 billion in sustainable investing assets globally. These are portfolios that integrate environmental, social, corporate governance intentions across the portfolio construction process. But more broadly across our entire platform, we integrate a robust sustainable investing approach across a variety of our aspects through our stewardship activities, through our own corporate social responsibility footprint. Sustainability is very much rooted in our culture.
Thanks for the short introduction. So now let us talk a bit about factor investing in particular. It's been around for a long time now, obviously, and it's been sometimes disguised by different fancy names, like harvesting risk premia, employing smart beta techniques, well, plenty of those. But it all boils down to seeking the risk-adjusted return benefits of certain factor exposures. So how would you describe Northern Trust's approach to factor investing, and which are the factors that are most important for you?
You are right to point out that both the sustainable investing field and the factor investing field really have a lot of confusing terminology in the space. I will try very hard not to refer to ESG as factors themselves for the purposes of our conversation. We'll talk about factors as compensated risk factors. So a distinct group of factors, right? Value, size, momentum, low volatility, dividend yield, and quality. Those are the primary sources of outperformance. And we can leverage factors in both public equity and corporate fixed income portfolios. Northern Trust Asset Management has been involved in the factor investing field for over 25 years. And we look for companies that fit certain criteria in a really intentional way to build portfolios. So for example, quality, as we look for high quality companies, we're really looking for specific attributes like profitability, like management efficiency, like cash flow. And we're leveraging this data to roll up into our assessment of factors. And as we define these factors, we can leverage them in portfolio construction in an effort to maximize return. So really, it's about efficiency. It's about achieving the most efficient use of risk possible and getting compensated for the risks that we take.
Mm-hmm. Right. So you mentioned several different factors that you look at, but well, value is perhaps the most well-researched of those, and normally value does really well in the economic recovery phase of the economic cycle, right? Which we probably are in right now. So let's just talk a little bit about the current economic environment, and if you could tell me a little bit on whether you expect value to outperform or quality, or what's the house view on the factor environment for the moment?
Well, value had a rally that really kicked off last year. Following Pfizer's vaccine announcement, we saw value really take on more of the spotlight. And to date this year, rally has really continued, but it's had an interesting run. Value still has some ground to make up, just given the sort of relative underperformance of value strategies over the past few years. But it's really a factor to watch. Earlier this year, the value rally could have been characterized by really being driven by lower quality companies. But the nature of that rally shifted towards the end of Q1. Now it's really being led by companies that are, they're relatively inexpensive, but they're also those that have more solid fundamentals. When we're looking at profitability, when we're looking at cash flow, when we're looking at management efficiency, we can find higher quality value companies. And so there's an interesting intersection there. With the interest rate regime in a steepening environment, and there's a rising yield curve, and interest rates are expected to rise as well. So the outlook for value continues to be very good, and I think for momentum as well. So that's a positive. At the same time, there's still record levels of volatility. The dispersion of volatility across different sectors is at a record level high. So one of the biggest possible risks that we see out there is really being exposed to unmanaged sector biases. So as we think about building that, intentional factor portfolios or multi-factor portfolios, it's a really interesting environment to target risk-adjusted return and to try to rein in some of those unintended biases. But I think a lot of it can be driven by intentional multi-factor portfolios. So bringing together the intersection of quality and value, for example.
Now to turn to something slightly different. So how do we factor in the ESG? Well, I was about to say factors, but the E and the E, S and the G that we normally call for factors, how do we factor in those in your multi-factor approach?
They can be integrated in a way to really strengthen the core of the portfolio. So as we talk about building, really thorough multi-factor portfolios or portfolios that integrate sustainable investing objectives, the intentionality of the portfolio design is really important. Because again, it's very easy to introduce unintended biases. It's very easy to introduce the integration in a way that could dilute those unintended, those intended exposures. ESG data, I've been involved in the sustainable investing field for over 14 years. I started my career at a data and analytics provider for ESG data. And there's been a massive uptick in the amount of information that is in the marketplace today, and the analytical models are much more sophisticated now than they were at the time. But nonetheless, we can still see biases in the information that's out there in the market. Inherent in ESG data, we can often see biases across different sectors. So some sectors tend to have higher average scores than others. Across regions, some regions tend to have higher average scores than others. Europe tends to have much higher ESG rated issuers, for example. And across size, so large cap issuers tend to have much more data that's publicly available, and there are biases that are inherent in that. And that can absolutely impact portfolio construction. Right. So as we think about building sustainable strategies, it's a similar conversation to thinking about multi-factor portfolios. As I mentioned, that dispersion in intersector volatility, it's important to control for those unintended biases, because that can help really impact long-term return objectives.
Right, the biases you mentioned, I mean, some people would even argue that those biases ultimately explain any systematic impact on returns that come through ESG. Would you agree with that, or is that the case according to you, that that all the effect of ESG can be explained by different biases?
Well, I think we can find robust ESG companies that are proactively managing their material ESG risks across sectors, in the same way that you can find value companies across sectors. And to do that, you have to acknowledge that there are biases there, but control for them. Value as a factor tends to have a higher preponderance amongst energy stocks, for example. And so as we're thinking about putting these two objectives into a portfolio, the interplay of that is really important, right? So knowing that the potential universe to pull from has a very high exposure to energy means that we could exacerbate those concerns or introduce really significant differences into the portfolio if we integrate a high ESG expectation or a low carbon footprint expectation. So it's extremely important that we think through and look across sectors so we can control for some of these biases and really build multidimensional portfolios.
Right, this brings me actually right to my next question, and that is the fact that value is typically associated with, as you mentioned already, a higher carbon intensity. So is it even possible, you would say, to aim for a higher exposure to value and at the same time for a reduction of carbon emissions? So how do you pursue simultaneously factor exposures and ESG targets?
With a very intentional design. And this is where, design becomes absolutely critical. Striking the right balance between these different objectives, building in portfolios that are taking long-term sustainability risks, a focus on capturing value as a driver of returns, and reducing carbon exposure. It certainly can be done, and it can be done in a resilient long-term position portfolio, but the design is really essential. Carbon intensity tends to focus, as you pointed out, on energy, on materials, on utilities. It's often, the case that 80% of the carbon produced in a given portfolio is going to come from 20% of the issuers in the index, and there's going to be a heavy concentration there. Value benchmarks tend to have a substantively higher carbon intensity for that region. As the value factor gains more attention, investors who sort of shift focus and allocate more to value could unintentionally be disrupting their carbon budget. And so, for that reason, investors who are seeking to really reduce their carbon exposure while also capturing value need to do it in a way that is avoiding allocating to unintended biases. As I mentioned, our approach to factor investing, our approach to sustainable investing tends to be multidimensional, and it tends to orientate towards a sector diversified implementation. So in a value portfolio, for example, our goal is to rein in those unintended biases and introduce more sector exposure, so not to be as concentrated, so that as we integrate a carbon intensity expectation, the goal there is not to totally dilute the value exposure that we're seeking to invest in. So there's a need to take a multidimensional approach to managing risks. There's a need to avoid taking on any unintended sector volatility in any value portfolio or in any factor-based portfolio. Integrating sustainability objectives and integrating carbon objectives just means that there needs to be a more sort of intentional focus on portfolio design, because it's very easy to introduce unintended biases.
Another challenge that a lot of factor investors point out when it comes to integrating ESG data is, well, basically the quality and the consistency of this data? Because factor investing, however we view it, it's a quant strategy, and quants are notorious when it comes to demanding better quality and longer data series. So how do you deal with this challenge? How do you deal with data that is basically only dating back since 2007 in any consistent way? Is it good enough for you?
Quantitative investors do like longer track records for sure. And the data for sustainable investing really does have a much shorter runway than we would tend to want to have for a quant strategy. But that doesn't prevent us from being able to identify interesting information in sustainable investing insights. Our philosophy on sustainable investing is that the health of the markets is really tied to the long-term health of the environment, to stable societies and stable workforces, to well-functioning, well-governed companies. We often see sustainable investing criteria as additive to the investment process to help manage and mitigate idiosyncratic risk, to identify companies that are poised to take on interesting long-term opportunity sets. While ESG data doesn't have enough information or track record to really sort of satisfy the expectation that it could be considered as a compensated risk factor, it still provides us with meaningful data, and it can still help be additive to the investment process. I'll give you an example. We often marry sustainable investing criteria with quality. Quality is, as I mentioned, sort of a cornerstone of our platform, looking at companies that have really robust management and oversight over their balance sheet. So it's financial sustainability. And this is the other side of the coin, right? One is financial sustainability, one is environmental, social, corporate governance sustainability. And historically, and to your point, historically is for data dating back to 2007, what we have seen is that higher rated ESG companies, where we find that intersection between high rated ESG issuers that are also high quality, over that time frame, that intersection of companies handily outperforms all other cohorts within their peer groups. Lower rated ESG companies and that are lower quality or somewhere in the middle, they have not provided as much, contributed to as much to performance as that intersection of high quality, high ESG issuers. So we're going to leverage that data in a way that is meaningful and intentional. But it is really interesting to see the way that it pairs with compensated risk factors like quality, to produce really, resilient, sustainable long-term portfolios.
Right. Well, listen, all quants out there, there is no excuse for you not to incorporate ESG data, even if the quality and the history is not long enough. But that was very interesting, mentioning the intersection between quality and ESG. Any other combinations that you would say are, that you have explored as a firm and that you would say are interesting to go further into? Any other combinations between factors and sustainability features?
Well, quality and ESG are a really compelling pair. But as I mentioned, building multi-factor portfolios in a way that avoids dilution can really also be compelling. So integrating value with quality and ESG, or value and quality and momentum with high ESG rated issuers, that can really improve risk-adjusted returns. It can smooth out cycles over time. So I think we're very excited to see the way that we can integrate sustainability objectives and low carbon objectives into multi-factor portfolios in a way that can really complement the factor exposures.
Wow, thank you very much, Emily. It's been fantastic, very interesting. Can you just give us quickly your takeaways from this webinar, just to wrap it all up? Thank you.
For sure. So combining value with quality and momentum, or multi-factor portfolios, can really improve risk-adjusted return and smooth out cycles. Using factors and ESG to strengthen the core of your portfolio would be another key takeaway. And lastly, when integrating ESG in the portfolio construction, the portfolio construction design is critical to avoid any unintended risk exposures.
Great, thank you.